Okay, first of all, I want to thank you for the financial support which got this project started. So it's a project in development. We are developing it in several directions, and this year we'll be applying to a more important grant in order to move it forward. And today what I'm going to do is give you some description of what the project is about and present some first results, as we already had a first look at the data. So in the past few years I've been working on evaluating the effectiveness of too big to fail policies. There are three parts to this too big to fail policy. The first part is structural reforms, where you can include limits to proprietary trading, separation between investment banking and traditional banking. But I also include in it the reform of the derivative market, the global derivative market, which aimed at forcing the big banks to hold more capital against the positions they have in this market, and also making the market more transparent in many ways. So in this paper, for example, we looked at this reform, and we shed light on intended and unintended consequences, and find that the reform had limited impact in that it led to shifting risk from one country to another due to the uneven application of the reform in different countries. A second pillar of the reform is capital regulation, the reform of the Basel Accords, introducing in particular surcharges for systemically important banks, so the total loss absorbing capacity. And we looked into this question in this paper. One problem this reform doesn't address is that large banks continue to have the possibility to use their own model to assess the riskiness of their assets, and we show in this paper how they strategically select the parameters of their model in order to under-report risk. So this project that I'm going to present today is about the third pillar of this reform package, which deals with improving the resolution framework and resolvability policies. So it consists in 2 points. One is to empower authorities in several ways, give them power to sell assets of a bank when needed to pay creditors, to set up bridge institutions, to convert liabilities, so-called bail-in, to decide on loss allocation, how to allocate losses between the different creditors, and there are also powers to dismiss management. The second component of reinforcing this resolution framework is to provide necessary information to the authorities for an orderly resolution, especially for institutions that are very complex. And that in particular requires banks to write living wills. Okay, so maybe I can write here. So we start with the reform. This reform is meant to reduce implicit guarantees that too big to fail banks enjoy. And so reduce the implicit guarantees mean creating a level playing field between big banks and small banks, and as a consequence of this reduced implicit guarantee, what you hope to obtain is reducing risk, systemic risk and individual risk. And the channels are reduced risk appetite, and reinforced market discipline. So our project is about first analyzing the timing, depth and scope of the reform, understanding why the reform was differently implemented in different countries. We hope this to give us insight about maybe some expected heterogeneity in the effect of the reform. For example, we are very focused on bail-in and the complementarity between bail-in and deposit insurance to understand why some countries are not adopting bail-ins. The second is to analyze whether reforms have had indeed the effect of reducing the implicit guarantee in order to reduce too big to fail and create a level playing field, which means the implicit guarantee should decline more for the big banks. And the third causality we want to analyze is the causality from reduced implicit guarantees to bank risk. And in doing this, we will analyze in details what the effect is on risk appetite through the franchise value of the bank, and secondly, on market discipline. So the reform was adopted starting in 2012, and by 2020, you had many countries that already had fully or almost fully adopted the reform. Here you have a chart of an index that measures progress in the implementation of the reform, and you see there are big differences across countries we want to understand in this project. Okay, so one first challenge we have to overcome is how to measure the intensity of this reform, its timing, its depth, its scope. And for this, the first way is to use the Financial Stability Board surveys. And the second source is the World Bank survey. Okay. A second way is to use market measures of the implicit guarantee. One way, which we privilege because we can calculate it over a large number of banks, is to use Fitch or other rating agencies' support ratings. So here you have what's referred to as the uplift, which is the difference between the support rating, which measures the implicit guarantee, and the stand-alone rating. Okay, so the difference tells you by how much the implicit guarantee reduces eventually the cost of funding of a bank. Okay. So the difference, the uplift, gives you a measure of the implicit subsidy, and what one can do is map this difference into differences in bond yields to have a measure, a dollar measure of the implicit subsidy. An alternative way of calculating the implicit subsidy is to take the difference in cost of funding between big banks and small banks that have equal credit rating. that have equal credit risk. So here, summarize what I just said. We start with understanding the choice of governments about resolution and bailout. Then we want to evaluate how effective it is in changing the market perception of implicit guarantees. So here you have, is it effective in boosting and enhancing market discipline? And then you have the second order effect we expect from the reform, which is to reduce moral hazard and to reduce systemic risk through two channels. One is the franchise value, and the other is risk premium. Okay, so these two effects are actually opposite, and the theoretical literature is not clear as to whether they will be actually the effect that regulators expect from this. Okay, so what does the theoretical literature say? So here actually, maybe before I go to the literature, you get some first measure of how the rating uplift has changed comparing pre-2008 crisis, 2008 crisis and post-reform. And you see that the reform has been perceived as credible, at least by the rating agencies. Okay, you have here almost a 4-notch decline in the implicit subsidy. Okay, but when you look at the effect on cost of funding, you don't have the same picture. Okay, so if you compare post-reform with pre-reform, actually we continue post-reform to have a funding cost for big banks that is significantly above the funding cost of small banks. Okay, and actually higher than pre-crisis. So it's not clear whether the reform has been effective. And it's not clear either in the theoretical literature. So you have some earlier papers that argue that reducing the likelihood of bailout will reduce moral hazard risk, because that will induce a situation where big banks have more skin in the game. Another paper argues that bail-in and clarity about the distribution of losses will reinforce market discipline, but you have a whole new literature that argues differently, you know. So few papers actually argue that bail-ins can be destabilizing. Actually, they can make a bank more vulnerable to a negative shock. Another paper argues that bailouts are actually good in preventing contagion during a crisis, contagion to other banks. So they make banks actually less systemic in this sense and reduce risk-taking as a result. You have a second paper which says that implicit guarantees have the effect of increasing the franchise value of a bank. And franchise value has a disciplinary effect on banks. Okay, if the franchise value is high, that is, profits are high, that deters shareholders from risky projects. Okay. And you have a third paper recently published in Management Science, which argues that bail-ins actually lead to higher risk-taking by banks because they are associated with higher cost of debt, lower profit, and therefore they incentivize banks to monitor less. They reduce incentives to monitor projects. So the effect from reducing the implicit guarantees to risk is not clear. It's an empirical question we want to address. Okay?
Yes, 5 minutes.
Okay, I'm there. First way we first look at the data we had is to estimate this relationship between the implicit guarantee measured by the support rating and financial risk of the banks. Okay. So let me go directly. Here you have some results. So we use a big sample of banks. And what you see is that a reduction in support rating does lead banks to have higher equity, to hold higher equity, to have to choose a higher equity to total assets ratio, and this is economically significant. And if you calibrate with this estimate the effect of the reform, which is to reduce on average the support rating by 4 notches, you get a significant effect, which is about 2% increase in the equity to total asset ratio. Then we looked at, this question we had about complementarity between other tools of the regulatory framework and the resolution regime. So is there an added value of this improved or more complex resolution framework? And we find that in countries where you have already a lot of restrictions on bank activity, where you have no generous deposit insurance, where the central bank is the sole regulator, and central banks are viewed as stricter regulators because of the interaction between financial risk and the transmission of monetary policy. You find no added value, no added effect of having of developing this resolution framework on top of these measures which are already implemented. Okay, so it's work in progress. We will write this research proposal, hopefully get funding to develop the project, to look at several measures of risk, to analyze the drivers of reform, to analyze theoretically and empirically the complementarity between different elements of the regulatory toolbox, in particular between bail-in and deposit insurance, and to investigate the mechanisms and channels from implicit guarantee to bank risk and systemic risk. Thank you.
How Fitch calculate that uplift? Because you described it as a market result, but we don't typically think of credit ratings as market results, but rather research results.
Yeah. So maybe I didn't express it correctly. So Fitch has 2 kinds of rating. They have what they call the support rating and what they call the standalone rating. So what enters in the support rating is 2 elements. One is the willingness, their assessment of the willingness of the supporter, basically the government, to support banks, to provide a bailout, okay, in case of difficulty. So they assess this as it's a function of fiscal capacity, basically, of the sovereign. The second element is basically the size of the bank, whether it's systemic, so it's the likelihood that a particular bank will benefit from the support, independent of its risk, okay? And the standalone rating only depends on the credit risk of the bank.
So it is more of a Fitch assessment than
Exactly.
say a market implied. credit
Absolutely.
risk.
The market implied will be the funding cost differential, basically. That will be market discipline element of it. Yeah.
Donc, I can see out of the subject, but it made me think about the clearing fee.
The what?
The clearing
Yeah, yeah.
fee. And I am wondering whether the clearing techniques and policies inspired this reform, and is there a specific treatment for the clearing houses itself?
Yeah.
Because I think they have the statute of banks, and so there are systemic nodes in the system, I would say. So I'm curious about the approach.
No, I didn't get into the details on the clearing houses, but there is a framework specifically for clearing houses.
Yes, that's what I wanted to check with you.
Yeah, there is one.
Because
yeah.
they are, actually very small, but they present, a huge systemic.
Yeah, absolutely, and I should look into it maybe. Yeah. No, but I was browsing through this yesterday, just yesterday. But there is a whole framework specifically for the clearing houses, indeed. Yeah. So maybe something interesting for us